This podcast is produced by Spin Market and Digital. Welcome to How to Money with Cole and Cole.
I'm Cole.
And I'm Cole.
We coach people every day on their money and how to plan for the future.
As financial advisors, we're here to have an honest conversation and educate you on investing, retirement, and everything in between. And we'll throw in some sports talk along the way.
Our mission and goal of this podcast is to improve your money journey and help you create the financial life you deserve.
So let's talk money.
And sports.
Welcome back to How to Money with Cole and Cole. I am Bailey Ashbrook, sitting here with investment advisors Cole Peterson.
The host. The host, Bailey Ashbrook.
Thank you.
The
How you
hostess
doing
with
today?
the mostest.
That makes me feel special. And Cole Jaskey.
Recent county champ.
Woo! See?
Yeah, so, just for our listeners here, they were giving me some constructive feedback that I have no energy at the beginning, the podcast. I'm like the direct guy. Let's get down to business. So,
I just love when you're like, "What's up, guys? How we doing?"
I know I gotta get rolling. I'm like a train. So
Yeah. Okay. Now, just quit being so modest. You won the county championship golf tournament around here, local golf tournament. You're now a local legend. First county championship. He shot 63.
Wow.
At the country club on Sunday.
Were you just feeling it? Were you in the zone?
Yeah, it was pretty fun.
That's the best feeling.
Felt like like I was gonna make everything, but I do work. Just for the listeners, think like anyone that knows golf, like, oh, you shot 63, you must play golf all the time. Like, I live on the golf course, but I do work quite a bit. So
for our non-golf crowd out there, 63 is like, I've never shot 63 ever at like Ida Grove Country Club, but not the Fort Dodge Country Club. And then also the course record is 61.
Oh, shoot. Think if you would.
So he was 2 strokes off the course record in a tournament where it's usually set up a lot harder than it is on a day-to-day basis.
And generally just tournament, your tournament scores are always going to be higher generally.
You were in the zone.
Yeah, it was fun, man. It was
I texted you when I saw that. I was like, holy crap, it was 63.
It was kind of like, I always think of like, when like my group I would play with, like no one was really talking to me. It was just like they knew I was in the zone. It's kind of like the pitcher thing.
It's like a pitcher with a perfect game going. Like you don't mess with them. But
it almost like freaked me out because we're a pretty casual group I was playing with. I'm like, oh, this is weird.
Was that the best you've ever scored there?
Yeah, the country club by far. Yeah, I've shot like low numbers at like little 9-hole golf courses that are really easy, but nothing like that, even close to that, and especially in a tournament. So yeah, it was fun. It was had it rolling. Yes, it was cool.
That's cool.
That is awesome. That's fun.
And then our very own Caitlin Clark with the SB college
athlete of the year.
That's so cool. Like out of all them, that's just so cool. Bringing it back to Iowa.
Yeah, that's really cool to see.
Well deserved for sure.
Yeah. Mm-hmm. Caleb, I didn't forget you. We kind of got excited, and Caleb's
okay.
here.
It's okay.
My 63, so
Yeah, I got 63.
No, it's fine. I'm good. So
it is funny because our summer intern Ben, who was on our last episode briefly, he's like watching these two like play golf. So he's an athlete, but now he's like, oh, to be in this business, you golf. So he's been taking golf it's so serious, like it's so adorable.
That's funny.
But yeah, what else is going on in sports real quick?
Hey, the NL won the All-Star game for the first time in like 9 years. So if my Cubs make the World Series, we got home field advantage. I'm keeping positive attitude about it.
Is that a thing?
Yeah.
Whoever wins the All-Star game gets home field?
Yep.
Absolutely.
I've never heard that before.
Me either.
That's the only league they do it in, I believe. So it's fun to see the NL win the game. It was like 3-2. It was a real close game, but I'm happy to see the NL come out on top.
We watched personal note here. We watched the home run derby, Kale and I.
We did too.
My 7-year-old and we immediately, he's like, Dad, we got to go outside. And we went out. We live on the backside of the driving range at the golf course. So we go out, and that's where we'll play catch, like baseball and stuff out there because it's wide open. And I have a bucket of balls. So he was trying to be, home run dude out on the golf range.
That's adorable.
Balls. It was so fun. It was awesome. And he's like doing the stuff those guys are doing. But did you see the kid that there was like a line drive, though they have the kids in the outfield, and absolutely just got decked with a ball,
really?
like line drive. Yeah,
that.
it's pretty.
That's dangerous.
Yeah, I'm kind of thinking they'll probably change that because of that situation. I don't know what happened to him, but it was pretty crazy watching live.
Make them wear helmets or something like that.
I mean, it was like a line drive, like in the outfield, and hit a kid like right in the head.
That's very dangerous. Hey, and speaking of, I didn't even ask you, how was the baseball game in New York? How was the field? How was the experience?
It was amazing. The Yankee Stadium is everything it's cracked out to be. New York's everything it's cracked out to be. Big cities don't bother me, obviously.
Oh, I love
going to
cities.
Chicago all the time. So We were only there really. I mean, if you look at our time that we actually had to spend in New York, it was only 2 days, not near enough time. I mean, we were there a total of 4 days, 3 nights, but there's so much to see in New York. It's unreal. And I feel like we only scratched the surface. And we never, we went down to ground zero.
That's how I was wondering. Did you get there?
Got to walk around for 10 minutes. But, I mean, there's a 2-hour tour that you can do.
You just weren't there long enough.
Yeah. And plus, we went to 2 Cubs-Yankees games, so that took up a lot of the time. And but the Cubs took 2 out of 3 from the Yankees, so that was fun. And, we had a great time.
Go Cubs, go.
What a great experience.
It was awesome.
Okay, we're going to dive into it. All things markets, the S&P, the Dow, the NASDAQ. What are they?
What is the market?
Yes, because we obviously, market's up today, market's down today. But for our listeners, I think we take for granted that maybe they really don't understand each market and index and how they work and what it all means. So
some of the terminology.
Yeah,
right?
Let's get into it. Some of the terminology. Okay, the Dow. Cole P., explain what the Dow is. Why is it the one most widely followed?
Yeah, so the Dow Jones Industrial Average came out in 1896, I believe, and I'm going to read this off my phone because I didn't know this. It was named after Charles Dow, who created the index in 1896, along with his business partner, Edward Jones.
Interesting.
Yeah, that's probably why Edward Jones.
Yeah,
Edward Jones.
Yeah.
I would say that's probably what why it's named
Edward
Dow Jones.
Yeah, sorry, that was
Yeah, so it's only comprised of 30 stocks, which is a very small number of stocks. Obviously, you think about the S&P 500, it's 500 stocks. And that's where I think if you're looking at the overall market, I don't think the Dow Jones is the best thing to look at.
But it is the most common, wouldn't you say that?
It's the most common.
That people quote or say, it's a common thing to say, but I think if you're in the industry, most people follow, the S&P 500, right? But
exactly.
I think the person that's not associated with the industry, they're going to say, oh, how's the Dow doing? That's a very common phrase we hear.
Yes.
Well, that's the one that our baby boomer generation grew up with.
Yep.
That was the only index to watch. So they've made changes over the years. So when it started in 1896, there was only 12 companies in the index, and by 1928 they had grown to 30. The longest tenured company that's in the index is Procter & Gamble since 1932. Most of them have changed a lot over time. The most recent change was in 2020, where there were some stocks taken out and other ones were put in. So how they make the decision of what stock goes in the index is based on how those companies are doing, and then if they have negative impact on the market, then they may be taken out of the
or their market size. Like say their cap, you look at how big they are, too. If they get really small, or some companies will do, spin-offs, or they'll divide into 3 business segments, maybe, something like that. So they might, remove one from the Dow. But just to put the 30 stocks into context, the New York Stock Exchange, so that's the largest exchange in the world. Now that's difference between exchange and index. I'm going to explain that. But the New York Stock Exchange itself is over 2,800 stocks. So think of how small, yes, large 30 companies, but very small sample size of the overall New York Stock Exchange or stock exchange.
And go into that because you were just going to say, I'm going to explain the difference between the stock market. Go ahead.
Yeah. So I mean, you're the same thing that maybe the older generation say, is it like the big board? Is it on the big board? That's something I've heard people say. And that's the New York Stock Exchange, referring to that. That's not an index. No one really keeps track. And, there's funds that keep track of all stocks on the New York Stock Exchange, but no one really follows that because it is so large. It's small companies, large companies, anything that can trade. Basically, that means you can trade that on that stock exchange, or a firm, or, someone associated with the business can. Versus the Dow is an index, that is...
Explain what an index is, though, for the average listener, like for Caleb.
It's a bundle of stocks, right, that Cole explained. He explained what comprises that Dow, that you could buy in certain formats. You could go and buy all 30 stocks, but then you have to own each one. Or you can buy the index, which basically means you own a percentage of each of those companies on how the index is, the Dow is made up. I don't know what's the biggest company in the Dow, Cole.
I don't know that.
I think it's Apple. Or Apple's the biggest in the S&P 500. I assume it's the biggest in the Dow. And the Dow, it used to be the industrials is what it was, originally timed, but now it's a lot different. There's tech companies in there. It's a wide range, but So if you own that index, and then you take the returns of those 30 stocks, that's what over that year or whatever period of time you're looking at, that's the percentage return you get.
Yeah. So, and I want to go back to the most recent changes. Like, this is what happens is in August of 2020, Salesforce, Amgen, and Honeywell were added to the Dow, replacing ExxonMobil, Pfizer, and Raytheon Technology.
Yep.
Is that how you say that?
Raytheon.
Raytheon. Yep. So they do make changes to it, but it is typically not a lot of change. So the other change before that was in 2018. So over the last 5 years, I made 2 changes, 4 companies. That's it. So they're it's pretty consistently the same companies, and the index is something that a lot of people follow and consider the market, even though it's only 30
air
stocks.
Quotes. Air
quotes.
It's like representing how the market is doing.
Right, but it's really not.
Yeah, it's a small sample size, I think. And you look at I don't have, I'm Mr. Stat guy. I don't have the year-to-date Dow and S&P, but there's a huge difference this year versus last year was what we consider a value year, where value stocks, and we've talked about that probably in the past, but value did really well or better comparative to growth stocks, which is more S&P, NASDAQ type, which we're going to go into a little bit further.
Which I was just going to say, the NASDAQ. Okay. Because Cole, you're loving the NASDAQ. Like, for example, we have annuities, and we're not going to get into that, but when we tell clients, like, oh, we're going to put you in the NASDAQ, or we're going to spread it here.
And that's an index.
And I think people, we just assume they're like, oh, okay, they're going to put me in the NASDAQ, or I'm going to follow the NASDAQ. And like, what is the NASDAQ?
So the NASDAQ is another index.
Yep. It's actually an index and an exchange, which is weird, but it's a little smaller size, so you can actually buy this exchange, which in theory is the index. So
right.
Too. So it's a little confusing. I know.
Yeah.
I know. But
you're confusing me.
I didn't make the rule. I didn't make the rules up. So
yeah. So the NASDAQ is comprised of mostly tech and growth stocks. So you think about tech stocks, most people think of Meta or Facebook and Apple and IBM and everything like that. But it also has some growth stocks inside of that, and it did bad last year. And the reason that I liked it at the beginning of this year, and now it's up a bunch this year, is that it was so far down, and it wasn't really for any reason except that the market, everything was going down, and they just happened to do worse. So I thought that they had a longer road to recover, or not longer road, more room to come up to recover here recently, and it proved right. Now that I still think they have a long way to run. So it's a riskier index than maybe the S&P 500 I would consider, but it is definitely shown that it can grow over time.
Okay, so Cole, you're mentioning growth stocks, and I know you, Cole J, said value, and I think we assumed, go into what growth and value stocks, the difference. Explain to him, Cole.
And I'll put it in context of the indexes, the markets we're talking about here. Cole's talking about the Dow. The Dow is more widely considered more of a value index. It's got stocks that pay dividends. They maybe have very, not as high, earnings growth each year, but they're profitable. Generally, value stocks are stable, profitable companies. So you think of ones like you mentioned, I think Procter & Gamble is one of the oldest in the Dow. That's been around for 100 plus years. They've raised their dividend for like 81 years straight, something crazy like that. Widely considered a value stock. Doesn't really grow. You're not going to have a 35%, 40% year in Procter & Gamble unless it's coming off a super low point for some reason, generally.
But you're almost guaranteed a dividend. So what a dividend is, and I'll explain that real quickly, is a dividend pays you on that stock. So if the stock is worth $10 and they're going to pay a 5% dividend, obviously you're going to pay 50 cents on that $10 stock. And then
good math there.
That did I do that right?
No, you did. I was just thinking. I was like, oh yeah, one number. Most people use 100. Just to use it, so I like it.
$10. Yeah, $100 would be $5. Obviously. So that 50 cents they're going to pay to you, and you can take it a couple of different ways. You can take it as a check from the company, or you can reinvest that stock, and that's what most people do. You can reinvest that dividend and buy more stock. So value stocks tend to grow less rapidly as far as their stock price, but they're going to pay more dividends, so you can accumulate more shares over time.
I always compare it to cash rent. You can you own a farm. And that farm can go. You can make 2 ways make money. That farm can go up from 10,000 acre to 12, or it can pay you $300 an acre in cash rent. That's the equivalent to your dividend. You know, in that point, I always use that when I'm explaining dividends. Most people, you know, like, oh yeah, I get that. Or owning a rental house, same type of deal. Now on the other side of that is growth, right? And that'd be more the NASDAQ. Cole said, hey, they're growth heavy stocks. That means their revenue growth, if you look underlying of their companies or their business models, they probably have a very good opportunity of growing, or they're growing very rapidly. They might have 100% revenue growth year over year, things as such. So generally they're more higher flyers. They can go up higher, they can go down higher because
risky.
Yep, the market's paying, right? The stock market's a capital market. You're saying, hey, I think that company deserves a higher value because it has the opportunity to potentially be, you know, really high revenue and then turn into really profitable at some point. And that's where the NASDAQ is comprised of more of those type of companies versus the Dow, or companies that are already probably generally all profitable, pay a dividend, you know, in general terms. So it's a difference. So they're not going to get as high of, you know, rapid appreciation in the stock price because, you know, they're pretty stable.
And those growth companies don't typically pay a dividend at all, or a very small.
All back in the company.
Correct. They're putting all back into, you know, research and development, or all kinds of different ways.
A lot of times they're not profitable. Yeah, they're not profitable.
Or they're not profitable
because they are trying to spend to grow. Amazon's a great example of that. They've done a ton of spending. They obviously, if they wanted to be show a really high profit, they could flip. Yeah, they could control expenses, but they're like, nope, we're investing in our business. We're growing. And the market has since said, okay, you deserve, you know, a higher stock price because we see that future growth.
We know that you're worth it.
Yep.
Yeah.
And instead of Amazon saying, hey, we're going to pay our stock holders this 5% dividend, they're going to take that 5%, that huge dollar amount, and put it back into the company and do, you know, build more buildings that they're warehousing, hire more people, whatever they're doing, they're going to put it back into the business. So it's just a different way for businesses to operate, and it's a different way to invest.
All right, we got the Dow, we got the NASDAQ, S&P.
Yeah, so the S&P 500, right? That's another one. I would say that's the index that I most commonly watch. I mean, I would say my portfolio is more tailored to like NASDAQ growth stocks. I'm pretty risk averse, so I'm comfortable with that. But the S&P, when I'm looking at client portfolios that are maybe, you know, I'm comparing them to, you know, their equity side of their portfolio, I'm going to refer to the S&P 500. And that is the largest 500 U.S. companies. And that's composed into an index. You know, in theory, that is not an exchange. Just
I
we're
think
talking
we're confusing people. Okay,
Yeah.
someone's sitting there right now and be like, what's a market? What's an index? Which one is which?
And just think the exchange is really just where you don't see this, but where the money's actually trading hands. You know,
yes. I was like doing this on
place.
video.
Yeah.
Yes.
Yep. It's a place to really all the, you know, wherever you have your money, whether it's Vanguard or Royal Alliance or whatever the broker dealer, they're trading at these exchanges. That's where the stocks are really, you know, going. It used to be the, you know, what you'd see on TV.
That's
the cool
what I was
thing
just
where
going to be. They're like all sweating piled in.
Yeah, sweaty.
Yeah, that doesn't really happen anymore.
You refer to that. It's weird though. You think of that exchange image. You do think of like, you know, people yelling and
sweatiness. That's all I think of.
But that's the S&P 500, probably the most widely invested in index because it's available in almost every 401k. They have an index fund that matches the S&P 500. And really what that is, they're mimicking the S&P 500, same type of decision-making process. You can, you know, I don't know. Cole and I were just discussing, we don't exactly know who's making those decisions of who's allowed in the S&P or Dow. We should do that research and come back. Because I don't know, is there a committee, you know, somewhere that's making that decision? But it is a big deal when a company says, hey, we're going to be in the S&P 500.
You hear Fortune 500 companies. I mean, that's where that comes from.
And then they're in that index that then, you know, people across the country are putting money into, and they're buying, the index is buying some shares of whatever that company is. So it is a big deal. And very widely followed, I think, across the board.
Right, and the bottom 10 to 20 stocks move in and out pretty frequently in the S&P 500 because companies grow at different rates, obviously. So those aren't decided on necessarily as good or bad. They're just the top 500.
Yep.
And they base the value of that company on market capitalization, which is the value of the business, right?
Yeah, and that's where I think people. Market cap weighting, that's a term that you hear in our business. That's something that I don't think everyone knows nor should need to know, but it is important to understand that when referring to the S&P 500 because
Explain that.
the S&P 500 is just the normal one. You can own what's called an equal weight, and I'll go into that after this. But an S&P 500 is market cap weighted. So it's what that means is the largest companies make up the bigger percentage of that. So for example, the Apple is about 7% of the S&P. Don't take my math exactly. It fluctuates daily based on the stock price. So. But really, Apple, Microsoft, Amazon, Alphabet, and Facebook, I believe, are the top 5 right now, and they're roughly 25% of the S&P 500.
And that's called FANG. Have you ever heard that term? Yeah,
yep.
yeah. Facebook, Amazon. What's the
Netflix used to be in the used to be in there.
And
Netflix
then Google, which turned is
Alphabet.
Changed, Alphabet now. So
I think Netflix is still in the top 10 in there. But that's one thing where you look at that, and a lot of that return, is coming from those top 10 companies.
Off those ones.
Really driven by those top companies,
and,
right?
And that's why generally the NASDAQ, S&P are relatively similar in return, generally, because the same thing, the NASDAQ, or if you buy that, it's got market cap weighting too. Now, you can buy what's called equal weight, and that's basically where there's equal weight indexes out there. You own all 500 companies equally. So it's 0.1% or what across the board or whatever it is for that index. But that is something you can buy, but generally then you're getting even returns, where right now it's been very beneficial to own Apple and these top companies. So the last 10 years, you'd want to be in a market cap weighted one.
Awesome.
Absolutely.
And now we have the crypto market. Not to get too in the weeds to that, but I saw it went up, but we do have that market as well. Do you guys want to go into that?
Yeah, I think our knowledge base is pretty limited, but there's some news on it. I know with, tied to the regulation, right? I don't know the exact stuff, but it did go up pretty positive the last couple of days based on this. There was a ruling that it is going to be treated more like a security, which I think is a good thing for protection of fraud and certain things. There's going to be some actual regulation and probably a ton to come, I'm sure.
And there needs to be. The cryptocurrency market it's the reason we don't have a great knowledge of it is because we're not able to sell it, trade it, do anything with it. As licensed financial fiduciary advisors, we can't do that. So cryptocurrency is something that is still kind of in the clouds, like it's something we can't reach. So it's not something that we are going to spend our time researching and finding a bunch of information about. Now, naturally, we hear about it all the time because people ask us about it, and it hasn't, it used to be a really hot topic like 2 years ago, but then it all plummeted, and now it's coming back.
It's cooled down quite a bit. I mean, especially the last year, I would say, which it's Bitcoin. Just that's the only one I really see. It stayed around the same price for the last, basically the last year. So, and then it came down from like 66,000 down to like 12,000.
Yeah.
So if you were buying it at 60,000, that's a tough, you got a lot of waiting to do.
But you see it when you look at the, you pull up your Apple or whatever, you see your stock exchange.
Or it's a headline.
Or indexes, you can see it. It's always a headline.
Yep.
Well, yeah, and cryptocurrency isn't part of any of the indexes or NASDAQ or anything like that. Now, whether the companies that are in the NASDAQ are investing in cryptocurrency, that might be something that might be happening.
Coinbase, for example, they're in the NASDAQ. Mm-hmm. They're an actual... Talking about exchanges, they're an exchange that you can buy, cryptocurrency on. So they're a stock.
So their profits are based on people buying and selling cryptocurrency.
Yeah, so kind of indirect exposure, and that's people do have that, across the board. So that volatility things, it's crazy. When you start thinking of the reach of the market, like down into that it has. So
okay, so we know there's more indexes. There's more out there. But the top 3 we just went over. Let's do a little recap. So we have the S&P, which is
that's the largest 500 U.S. companies.
Dow Jones
is 30 companies that are large cap companies that they're picking basically to be in the index.
The
NASDAQ, exchange and index, growth. A lot. I don't even know how many are in there, but a lot of growth stocks, primarily a lot of the tech stocks.
A lot of tech.
Tech heavy.
Okay, so we've explained them. Okay, I'm a client. How are the markets doing today? Like which one, you know what I mean? Explain to them maybe what to look at, what to follow.
How much is the Dow up today, Cole?
Yeah, so I would say that the one, and I agree with Cole, like the one I look at the most is the S&P 500, because I think it's more of a vision of actually what's happening with the quote unquote, again, air quotes for our podcast list, the actual market. Because if you look at just the Dow, it's only 30 companies, so it's not a real good snapshot of what's actually happening. And the NASDAQ, those are not the top 500 companies. There's a lot of small companies and also large companies. So I would say that's not the quote unquote market either, because they're all growth companies. So the S&P 500 has a mixture of growth and value, and it's the top 500 companies. So that's what I would look at.
Same here. That's exactly. I'm gonna co-sign on that one. Hey there, listeners. This episode of How to Money with Cole and Cole is sponsored by BetterHelp. I don't know about you, but for me, finding the work-life balance of being a husband and father and working a job has been so rewarding, but it also can be so exhausting. And that's why it's important for me to take care of my health, and not just my physical health, but my mental health. And that's where therapy comes in.
BetterHelp is the world's largest therapy service. And you know what's great about it? It's 100% online.
With BetterHelp, you can tap into a network of over 30,000 licensed and experienced therapists who can help you with a wide range of challenges. To get started, you just have to answer a few questions about your needs and preferences in therapy. That way, BetterHelp can match you with the right therapist from their network. Then you can talk to your therapist however you feel comfortable, whether it's via text, chat, phone, or video call.
You can message your therapist at any time and schedule live sessions when it's convenient for you. If your therapist isn't the right fit for any reason, you can switch to a new therapist at no additional charge.
With BetterHelp, you get the same professionalism and quality you expect from in-office therapy, but with a therapist who is custom picked for you with more scheduling flexibility at a more affordable price.
Find more balance with BetterHelp. Visit betterhelp.com/CFG to get 10% off your first month. That's BetterHelp, BetterHelp.com/CFG.
All right, let's do a little dollars and cents.
Dollar bills, y'all.
I feel like Cole J always gets dollars and cents, and he gets his little notebook. Look at him. If you watch us on YouTube, which, do, but look how cute
It's
he
his
is.
thing. He's such a stat dork.
Well, I love it. So we've talked, I'm going to get into the content here, guys, okay? So we've talked primarily about the equity market, stock market. I'm going to talk about bonds for a second. That's a hot topic.
A real exciting topic
yeah,
here.
Sorry for, but headline, no bonds for boomers. So this is a stat, quote unquote, stat guy taken from Vanguard. I found this very interesting because of the last 2 years, and we're talking about indexes, returns, a lot of stuff here. Vanguard had a stat here. Investors older than 55 had at least 70% of their portfolio allocated to stocks. Compare that number back to 2011. That number was only 38%. So what that means is, people 55 and above are a lot more aggressive, or have a lot more stock exposure than they had, a decade ago or, 2011, which to me, we were kind of saying, well, why is that?
Why would they still be aggressive at this age?
I think a little bit of it is, obviously what happened to the bonds last year. Bonds got just absolutely knocked out last year.
Interest rates.
Maybe explain why.
Yeah,
For the
interest rates.
listeners.
I mean, bond values have an inverse relationship
Teeter-totter.
to interest rates. So if interest rates, short-term or long-term rates go up, generally bond prices, depending on if it's a long or short-term bond, are going to go down. The values are now. And that's really, we had a lot of that last year. I think some of it is, though, in getting deeper into the weeds, I think the older generation actually has gotten more adept to making some of their investment decisions, and maybe just naturally, and that's what some of this, study I went into, it says that they're making a little bit more versus younger generation, which you should be all, at that point of younger, you should be more aggressive, you got more time. But that's, some of it's that, but I think a lot of it's the impacts of what interest rates, things that have happened, inflation the last 2 years.
I think people understand what stocks actually are. If I just went to Caleb and said, "What is a bond? Explain a bond to me," I don't know if you could. I mean,
He's
do you think
shaking
you
his
could?
head.
I
No.
could not.
True, and I think people understand what a stock is, and they understand that they're volatile. Well, bonds were just as volatile last year, and I think that maybe the older generation has also seen the run up in stocks, and they're like, okay, now we understand that there's fluctuations, but still over time, I'm going to make more money in the stock market. Why would I stick my money in bonds and cut this coupon that is worth 10 years ago or 2 years ago, was worth 3%. Now it's higher, but why would I take 3% when I know that I can average 8% in the market as long as I can handle the volatility?
I was just going to say, understand that they can
And
understand
some people can't.
volatility.
So, yep.
Some people can't, and that's when we're dealing with clients, if they can't understand the volatility, then we don't put them in that situation. But if people can withstand the volatility, we're going to at least have part of their portfolio in the stock market.
Are you going to explain to Caleb what a bond is? I mean, because the title is the boomers and bond.
Yeah, bond, the best way I could explain it, I relate it to a CD at the bank, right? You give the bank $100,000, they're going to pay you an interest rate of 3% or 5%, whatever it is, for a period of time. They might say 1 year, 2 years, 6 months. Bond is the same thing. And then that bank's probably going out. They're either putting it in their reserves, right? They're taking that money and maybe lending it out to a customer that wants a commercial loan. A bond, exact same thing. Public school wants to spend $30 million on a school. They've got to find that money. They're going to sell bonds. That's a debt instrument that they go and raise that $30 million. And in turn, they're going to pay you 5%. And it might be a 10-year bond. And they say, okay, you're going to give us $10,000. We're going to pay you 5%. At the end of 10 years, we'll give you your $10,000 back.
The difference is a lot of people don't hold it until the end of that 5 years.
You can sell it.
Yes.
You can sell it, and then the value can increase or decrease based on interest rates. And if you're selling the bond at a lower price, obviously, then you lost money on it. But if you hold it to the end of the term and get your par value back, is what it's called, you would get all your money back.
The percentage they guarantee.
And over that, so example, that would be, so say you bought that 10-year bond 2 years, and that paid 5%. 2 years later, that same 10-year bond on a new school is paying 7%. What's the value of your bond on the market? It's probably lower, right? Because why would someone pay your old bond what they could get a new bond for? So that's what kind of happened last year. Or think of where rates went. Bond prices were paying, or bond interest rates were paying like almost nothing, and people had 20, 30-year bonds, and rates went up to where bonds were paying 5%. So no one wanted anything for those old bonds. So a lot of people, really are digging themselves out of holes still, on the bond market.
So now those old bonds are basically worthless unless you hold them as long as the term is. Yeah.
Yep. And which you can. That's the good thing with you own a good quality bond, or whoever the issuer is of that bond, as long as they have good debt or good credit rating. You just hold it to maturity. You're going to get your money back plus your interest rate over the time.
Okay, so Caleb, you got all that,
I was
right?
just going to say that.
Definitely
Totally
got it
understand.
all.
Okay,
I just
quiz
wanted to
will be
give the
later.
listeners that too, because you're saying boomers are avoiding bonds. So let's talk about boomers. So what is the average, what did we say? Because we looked into this, the average retirement savings of a boomer.
Yep. So baby boomers, from the data we were polled, it was $365,000 was the average retirement balance of a baby boomer.
In their, I think it was Fidelity was the source that we pulled that from. So, so that was in their retirement accounts. So not saying what they have outside of retirement accounts. This was in their retirement accounts. So IRA, 401k, what they have saved up for retirement.
Their nest egg. Okay, because we've been talking a lot about benchmarking in the indexes. So do you think that's enough?
Well, do you live in Fort Dodge, Iowa, or do you live in Phoenix, Arizona?
No, and that's a good point, because we talk about this a lot. Like, how much do you need in retirement? And
yeah, it's so variable, and I know we kind of give that disclaimer all the time. It's like it's all based on your situation, and how much you are willing to or wanting to spend in retirement, how much you're not wanting to spend in retirement, and what's your expenses. Is all your debt paid off? Do you still have a house payment? Do you pay rent? There's so many different factors, but I would say that is a not shockingly low amount, but for Iowa. But if you live in California, that's probably a shockingly low amount.
That'd be tough.
And in the inflationary period we just went through, where now I know it's pulling back a little bit. We got some good data here, but you look just what inflation does on that money. If you're not earning, a good rate of return, and inflation's at 3%, 4%, 5%, you're really not going anywhere. And then if you're taking anything out for income, you're really going backwards. So longevity is always a risk there of really knowing that you're saving, doing the calculations on, hey, what do I think I'm going to spend? How long do I think I'm going to live? It's really important to make sure you're having those conversations.
And we get that question all the time. Do I have enough saved up? Yeah. Will I have enough saved up? And that's interesting too, going back to that boomers having more in the stock and being able to stomach that. Are they doing that because they want their money to last longer? Are they okay with that? Do they don't feel like they have enough money and they're trying to make it up? There's like so many variables in that.
And it comes down to also like, how are you invested? If you're invested all your $365,000 in a money market that's paying 2%, do I think you have enough? Probably not, because it's not going to grow enough for keep up with your expenses over time. Now, if that 365,000 is maybe not all in the stock market, but in a nice balanced portfolio with some stock, and it's going to maybe average over 7-8% per year, then maybe you do have enough, because we're going to be able to keep up with the withdrawals that you're going to be able to take out, but where 2% probably it will not.
And I was thinking this too, because what'd you say? How many boomers are managing their own investments versus Gen Z? Is that the one you referenced?
Yeah. So this was from Fidelity. Is that 53% of baby boomers pick their own investments, compared to 42% of Gen X and 25% of millennials, which I think that number would be the other way around in my mind. You would think millennials would be the ones that have access to technology, or buying on Robinhood or whatever it might be. So in reality, boomers are making more of their investment decisions than the younger generation.
I'm gonna put Caleb on the spot. Why do you think that is, Caleb? Because that's your generation. Like, why do you think that the generation that you're in does not pick, or does not do their own investing, I guess?
Well, first of all, I'm Gen Z, not Gen X or millennial.
So you're younger than those. Aged us all.
Wow.
That Gen Z, man, they're
Yeah.
direct.
All right.
Maybe it's different for you, because that stat's not in there. But
well,
But
most-
obviously it's
most Gen
going
Zers
down.
are younger than me, because I'm
Yeah.
on the front end of Gen Z. So people just don't care enough to do their research on their own, and they'd rather just make somebody else do it. I mean, I don't
That's
know.
fair. Or how many boomers are just, their retirement accounts are just sitting there and they haven't looked at them. You know what I mean? And they're saying they're doing it. I mean, there's so many variables we don't know, but that is a very interesting statistic. But my point is, when you get closer to retirement and you're in that gap, like knowing your portfolio, what the implications are if it's fluctuating too much, and can you handle that? Or do we need to lock some of this up and keep some of these gains? Like, these are great questions to ask your advisor.
I think part of that might also be so many people are wrapped up into what they're doing in their retirement account, their 401k, their IRA, that they're not investing on their own, where 50 years ago people didn't have the option of doing that, so they started investing in the stock market or mutual funds, or so that baby boomer generation grew up with buying mutual funds from your local financial advisor, from the person at the bank, and doing non-qualified money in that, and the generation that Caleb and even us in this room
a little
are
more
in,
automated.
we were all, well, yeah, we're taught to save in our 401k or IRA, and in a non-qualified account is almost unheard of.
That's a good point.
That's probably a lot to do with it, because I bet that if you broke down those numbers and where that money is actually allocated, you'd probably see more non-qualified or non-retirement dollars in the baby boomer, which is common sense. They're going to have more money anyways, just based on age, but that's probably some of that stat.
Also, do you think it could have something to do with just the older you get, the closer you get to retirement? Maybe say some of these older people, they feel like they don't have enough saved, and so they're like, I can do it myself and I can make more.
Yeah, they don't want to go talk to someone.
I can be smarter about it and be more aggressive about it than if I went and talked to somebody like one of you guys.
And I was just going to say that too, maybe like the accountability, because you can just go buy an index, follow it, invest it, and there's nothing wrong with that. A lot of people do that. But I do think just working with someone and discussing like where your portfolio's at, and like planning ahead, and like the accountability of it.
They are harder to, I will just say, I'm just thinking like scenarios, baby boomer clients, definitely tougher a lot of times if they need to make bigger changes, to get them to commit to those changes versus, and maybe that's, coming from their experience. They feel like, versus a younger person, a lot of times will take some advice pretty easily.
Yeah, generally, they're like, tell me what to do.
Yeah, help me out. Like, get this started. Go, you do it, and versus, and now I have baby boomer people that aren't that way either, but I will say the tougher ones, I'm like, you really need to do this. A lot of times it's them that are pushing back, or that age generation that's pushing back, and it could be just generational on how they make decisions,
and maybe a little more trust with that, because they haven't seen there's so much regulation now that the baby boomer generation has seen the scams and the Bernie Madoffs and all that stuff.
Yeah,
and I don't even know if Caleb, have you ever heard of Bernie Madoff?
No.
Give him a 30 second.
So Bernie Madoff created a Ponzi scheme and took a lot of people's money, and he was a trusted financial advisor.
$50 billion.
Yeah. So people in the baby boomer generation have seen Ponzi schemes, things like that, where now, again, things are so heavily regulated that your group maybe just be like, oh, well, they know what they're doing, so I'll just give them our money and have them do it. Where that baby boomer may say, I don't know if this is for real or a scam. So
And we do, because the older people, are you a fiduciary? Are you a fiduciary?
Yeah,
It's
they're
like,
the ones that are asking
and
that.
if,
Yep.
like that means
Which is a great question.
Yes,
Yeah,
but
should
they're-
ask it.
You should, but a lot of older generation keeps, and they will not get off that because they want to make sure, can I trust you? Are you
Yep.
going to do what's right? Where I feel like the younger generation just trust you. They don't even like really understand that. I mean, they understand it, but they just know you. Like, okay,
They're
you're-
quicker
Yeah.
to trust probably at
Yes.
times.
I would say so. Yeah.
Behavioral finance. That's a topic
Yeah,
we were kind of.
we really need to get a guest on
Yep.
for the behavior part. But that's great. That was a good breakdown of all the markets. I want to end this.
Do you have
Got a
any?
quote?
I was gonna
Oh.
ask a question.
Oh yeah, please do.
So you got any upcoming golf tournaments or anything that we should know about?
Not really.
No.
We got the member. Our member guest is in August. That's a little different. You play a team. But that's always a really fun thing. But other than that, the golf season's pretty wind down. I might play one or two more things, but nothing crazy.
It wraps up right around the 4th of July.
Okay.
So it's 4th of July and then the county tournament, which I didn't play in because I was in New York. But there's not a lot of tournaments after this. We'll just go out and have some fun.
Wait, cool.
There you go.
Your best squad's coming to play with you in a couple weekends. This is your A team.
What are you talking about?
Me,
The
Molly,
Growth Alliance, the Growth
boy.
Alliance golf outing.
Yeah.
No,
Cole's
it's a different
golfing with
tournament.
me and his wife, and me and Molly. We just were there for a good time.
Hey, I won a tournament with you and Molly one time at
That's
the Growth
true.
Alliance outing, but yeah, we'll see how that goes.
That's great. Achievements on the golf course are not what matters. Decency and honesty are what matter. Tiger Woods.
Go Cubs.
You've been listening to How to Money with Cole and Cole, the podcast of the Central Financial Group, courtesy of Spin Market. To learn more, visit their website at www.centralfinancialgroup.com and follow them on all their social media platforms.
For now, I'm Cole,
And I'm Cole.
and we'll see you on the greens.
Four.
Securities and investment advisory services offered through Royal Alliance Associations Incorporated, member FINRA, SIPC. Royal Alliance Associations Incorporated is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Royal Alliance Associations Incorporated. Material discussed is meant for general informational purposes only, and it is not to be construed as tax, legal, or investment advice. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Past performance is no guarantee of future results. Diversification does not insure against loss. Any guarantees discussed refer only to fixed insurance products and are backed by the financial strength and claims paying ability of the issuing insurance company.